Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
So we found an opinion piece online. We wanted to share it with you. The title of the opinion piece is that housing prices are still surging, but a bubble doesn't seem likely. So we read the whole article, and literally, what I believe is that they watched this program and they just put it all into here, because literally we've said everything that's in here. Either because we're just pumping the market, apparently what some people think, or we're actually right? So, but the reason why we're going to go through this article is it had some really cool charts. Mm-hmm. I know you guys all like charts. So
we all like numbers and we like data.
Yeah, we like data, because if you don't have data, and if you're watching somebody's video and they don't actually show you the data, if they're just talking, or if they just drew something themselves and said, oh, this is what I think is going to happen, that doesn't really mean anything. So we're going to go into the first chart. Mm-hmm. So I'll go ahead and put the first chart up. Now, what this is very interesting. Okay, there's three things on here. Okay, so you have the 20 city home price index. They took 20 cities and they made a home price index. Those are the blue up and down lines. That's the home price index, okay? Then they have the year-over-year change for housing prices. So on the left-hand side is the home price index. On the right-hand side is the year-over-year change. And then 0% has a little dashed line, so you can see what that is for home prices going up. Okay. Now, you're probably saying this is really confusing. It's actually not really confusing, and this is why. Because while home prices have had a high year-over-year change, affordability has also had a high change. So that orange line tries to catch the blue line. Those should be in pace with each other. One's affordability and one are home prices, okay? Now, if you go all the way to the left side of this chart, you'll see that the home prices were high, but affordability was low. And what happened? This was 2005 and 6. Mm-hmm. Housing crash, right?
Right.
Okay, now when it crashed, it actually fell through affordability, mm-hmm. and it really, really tanked. And if you go all the way to 2009 at the bottom, that was literally the point at which, if we say time the market, mm-hmm. you should have bought like every house you could have got, because that was literally from an not necessarily an exact low price point, but affordability 2009. I mean, it was pretty affordable because there were still loans.
Right.
And there were a lot of people who didn't buy houses. And when in 2009 rolled around and they're finding these homes that used to be $1 million for $450, and now they qualify for this house because they've been saving and stuff.
Well, so something I want to point out, because it just kind of occurred to me when you were talking. So you're looking at 2009 being the most affordable, but it was 2011 that was the bottom of the market.
Right. So,
that right there shows you that disconnect.
Yep, exactly. And if you look at 2011, prices are going up from a % year-over-year change, mm-hmm. but they're still lower, and it was, at least in our market, it was lower. It was lower in 2011, okay? Now, for most of this, and then you had 2014-15, which was actually kind of a bubble, because the home affordability didn't go up very much, but we had home prices going up over 10% for a couple of years. Yeah. We kind of had a run in the middle of that. Mm-hmm. And then, and you can see what happened is home prices didn't go down. Now you see the arrow go down, but it's still above zero. As long as it's above zero, it means prices are still going up. And like what Juana said, 2011 was the bottom, and you see that chart and it goes up, but remember, to the left of it's below the line, so it's still, prices are declining every year, which is what you saw in 2010. 2011 was actually the first year they started to go up. Mm-hmm. That's why I want to say it was the bottom, because that year they went up like 5%, but mm-hmm. But from the beginning to the end of the year, it had just finally started to go up. That's the first year prices came up. That's why this is confusing. This is not a home price chart. This is a percentage chart. But what I want you to do is look all the way over to the right of this chart. This is the money shot of the chart. The home price index, this is the affordability index, is up 15+%, almost 15%. It means homes are 15% more affordable. So home prices are going up, but they're chasing affordability, mm-hmm. right? Because you can't just look and you say, well, wages. Everyone's saying wages aren't going up 15% or whatever, but it's more than just wages. If we're going to do a whole nother video on this, but if rents go up 20% and home prices don't go up at all, homes become crazily more affordable relative to rent. So when rents go up, if rents go up 20%, home prices need to go up 20%. And that's the thing everybody's missing. This affordability index. You have to have a place to live, right?
Right.
And when you see how close these are, this doesn't show anything like a bubble. If you look all the way to the left, you have a huge gap between the affordability going up and prices going up. Huge gap. Prices are going up, affordability is not going up. But when you look over to the right of this chart, that blue line that's taking off there is home price index, which is the affordability index, is going up. And so home prices are just following it, market forces.
They are. So it's really, I know it's confusing, but this chart, if you just spend a little bit of time looking at it and really trying to understand it, it will all make sense. I think Todd did a good job explaining it.
Yeah. The only time when the home price affordability declined was between 2009 and 2015, which is what we call the Great Recession. That was really when there were job losses and things like that. Homes became not very affordable. Fortunately, during that time, home prices were not substantially going up. You can actually see 2012 and 13, a year-over-year change of home prices declined a little bit. That was like the post. When it hit the bottom, it started to come back out. It declined a little. A lot of that was some more foreclosures that just happened to come out those years.
Right. So I think a lot of that, it was more of a tapering, but I don't think this shows it quite that way. But I think that's the way we experienced it. It was more of a tapering.
Right. Okay. Now the next slide is something. Now this is a national number. So this is months of supply. Now if you look back to 2013, 14, 15, 16, 4 to 5 months of supply. By the time you get to 2018, you still have 4 months of supply. 2019, you have 4 months of supply. 2020, you have 4 months of supply. That's a normal market. That's like the normal healthy market. Now you see that spike? That spike was COVID. That little spike, the beginning of 2020 was COVID. And that's because there were no home showings. There wasn't a lot of stuff going on. And then you see the drop of inventory. Because what happened? People started going back home to their little apartment with 4 other people and said, you know what? We're working remote. We're going to go buy a house outside the city. We don't have to live here anymore. People just said, you know what? If I'm going to spend all day in my house, I'm moving out of this little house. I'm going to go buy a bigger house.
Right.
And that is one of the things you could see that it just in 2020. Remember, this is still during lockdowns and other things. We went from over 4 months of supply nationally to under 3. So we lost a whole month of supply in just maybe a quarter of the year.
Right. So remember, this is a time when everybody went home. So before that, we would spend, a good portion of our day, certainly 10 hours a day, between 8 hours at work and a couple hours of commuting, and then maybe we go out to dinner and run errands and whatnot. So we weren't spending all this time at home. Now, all of a sudden, everybody's spending all this time at home, and their home environment takes on this completely unusual importance, because now people are spending literally 24 hours a day at home. They're getting everything delivered by Amazon or by whomever. Their groceries are being delivered. Everything's being delivered. So they are almost prisoners in their home. So now the home becomes much more important. And because of that, people are at this point looking to improve their home life. And that may mean that maybe they don't want to live with as many roommates, or they just need more space. They're also, because they're working from home, some companies are telling them, hey, even when this is all over, you can still work remotely. So now people are having more choices about where they live, and maybe they're relocating not just in that general area, but maybe they're relocating farther away, maybe even a different state, maybe being closer to family or a more affordable place to live. So there's a lot going on at that point, and that is all soaking up the inventory. The other thing that's happening is kind of this perfect storm. You've got the millennials. The millennials kind of got a late start as far as their home purchasing, but they've now caught up. they've established their careers, they've got good jobs, they've got savings, and they're ready to purchase. So they've entered the market. So a lot of different things kind of came into play to absorb the inventory.
Right. This inventory is really important. And until we see 4 to 5 months or more, there's not going to be probably price declines. I mean, as long as that this is below 4, you can forget prices stopping or going down. It's not going to happen. So when they say bubble, it's going to crash. Well, how? Like, it's not, prices aren't just going to start going down. If prices started going down, all those buyers would freak out and go buy it. They would. It's supply and demand. It just the whole thing where prices are high, it's going to crash because that's what happened in the last crash. But that wasn't caused it. High prices didn't cause it. Too much inventory caused it. Speculation caused it.
Right.
It's in the article.
So
we'll put a link to the article below in the description. You can go down there and click on it. You could read through the whole thing, and it's literally what we've been saying for 2.5 years or 2 years.
Right. So one of the things that the article talks about is, as far as the inventory, that we can't be in a bubble so long as we have a shortage of housing. Part of the reason why we have a shortage of housing is that the builders definitely became gun shy after the Great Recession and after all of that happened, and they really have not built up to what they should have been building. And we've talked about that in previous videos when we talked about that we have not seen this low of a number of homes being built in a decade since the Great Depression, which was almost 100 years ago. So that's part of it. The other thing that I think has not been discussed for a while, and I've brought this up before, is that we are in a situation where people are living longer, they're living healthier, so they're staying in their homes longer. So that means that we've got the boomers who should have been downsizing from those big houses, but they're not, because they're still healthy enough to take care of them. They have the funds to take care of them, so they're still staying in those big houses. They're not turning those big houses over to other people. Now, you may say, well, but that would have been a wash because they would have sold the big house and maybe, gone into a smaller home, so that would have been a wash. And that is a valid point. They may have also gone into other things like assisted living and that sort of thing. So that's part of it. So there are a lot of different things playing with this number with the inventory. But the bottom line is that the inventory is low. The inventory is low because the builders didn't build. The builders didn't build because of the Great Recession and what that taught them. The builders didn't build because there are labor shortages. The builders didn't build because of material shortages. So there are all kinds of reasons, but the bottom line is the builders didn't build. And
here's 2 other things that are very important. We've had 2 major structural things change in the last, say, 15 years. It was common knowledge 10 to 15 years ago that the median time someone stayed in a house was 7 years. Okay? Just in a decade, it's 10 years. So you have less churn. People aren't buying and selling they're not moving every 7 years. It's now 10 years. The other thing is the people who, what Juana was mentioning, they sell the big house and they move into the smaller house. Historically, that was done because you have the house that you raise your family in and you work and you make more income, but then when you retire, you have less income, which most people do, right? And so they have to move in. It's a financial thing. They have to sell and move into a smaller house. They can put some cash in the bank, and then, because a lot of times what they make in retirement isn't enough money to live on, right? The problem is who's retiring? Well, it's only boomers right now, because Gen X, that's me, and Juana, we're not retiring, it's boomers. And boomers are the wealthiest. They're the wealthiest generation. They're the wealthiest generation in history. And they don't have to. They just don't have, they don't all have the financial, I've got to sell this house because, we can't afford it. They're like, oh, we got a ton of money and it's a pain. A perfect example, people live next door to us.
They're in their mid-70s?
Mid-70s. They're in a 6-bedroom.
5,000 square foot house.
5,000 square foot, 6-bedroom house. It's massive. And they're in their 70s. And it was the house but they don't have a reason to move. Like, why would they want to move? They've been in the house for 40 years or something. Right? So, 30 years. So, the bottom line is, those are structural things that have changed. And that's why you can't go back and look at stuff that happened 15 years ago and then exactly say, well, if that happened, this is going to happen because other stuff changed. Ceteris paribus. All of the things being held equal, they're not held equal. We have a bunch of those we've talked about, all the other videos. Okay, this is the last slide. Housing Affordability Index. This is a almost exact same one we had in a previous video, but I'll put it up here for you. As you can see, now I'll explain this. The bottom, the lower number is homes are less affordable. The higher number is more affordable. So a bigger number is more affordable. So if you look at 2006, homes were least affordable because prices were high. And then when the market crashed, you see that big spike up. As homes got cheaper, they became more affordable. And they continued to get more affordable to 2013, 2014. And then they've sort of danced around between 200 and 150. Now, until that home affordability, now it's certainly not as affordable as it was 5 or 6 years ago. But if you look at this chart, home affordability is the same as it was in 2018, 2019. And no one was saying in 2018 or 2019 homes weren't affordable. Because remember, we're not talking about the price. We're talking about affordability. It includes what rents are and that whole other thing. And if you take this chart back far enough, which we did on our other video, we went back to like the 60s or 70s. You have to go any time before 1990, homes were less affordable than today, even with home prices where they are. So home affordability is more than just the price. You can't just do that because people, it's wages, it's what rents are. And here's another thing. So let's say the COVID changed everything, changed the landscape, it reset all the numbers. It's a new playing field, right? It's a whole new set of rules. So what do people do with their money? We should probably do a whole video on this, but I'll throw it in here just because I think it's fun. So let's say you make, we'll just say $5,000 a month. That's what you make in a month. And let's say you spend it all. You don't have any savings. You spend it all. What happens when some of those things you used to spend money on, you don't spend money on anymore because things have changed? Maybe you're not going out to dinner, or you're not going traveling, or you don't do other things, or you just made a decision to prioritize, hey, I don't want to rent and pay $1,500 a month of rent. I'd rather go pay $1,500 a month on a mortgage. Okay, now you're adding, you're shifting your priority. What I believe happened, completely anecdotal, was that COVID caused people to change their priorities.
Absolutely.
And if you're watching this, I guarantee you, there were some things became a big priority for you.
I think we all changed over the last couple of years. Yeah,
we have changed, and because of that, I think people. And Wanda likes to use the term hunkered down. I think people wanted to have a place that, they were tired of being evicted because, or whatever during COVID, and they just said, I'm just going to get my own place.
Right. And, look, the nesting instinct is very strong in people. And that really took hold during COVID. We all nested, we all feathered our nest, right? Because we all ordered everything we could from Amazon, we all bought everything we could from Costco. But at some point we ran out of room and we ran out of things to buy. And once we ran out of room and things to buy, then we just started saving. And Americans have had the highest savings rate we've ever had over the last couple of years, mostly because we really didn't have much to spend money on. We couldn't travel, we couldn't go to the movies, we couldn't go out to dinner. There was no point in buying new clothes because, we were all in our pajamas.
No need to buy a new car. There's nowhere to go.
Right.
You're working from home.
We weren't getting haircuts, we weren't getting our nails done. We weren't doing a lot of things. That's one of the things that's kind of interesting to me. COVID is pretty much gone. Life has pretty much gone back to sort of normal. But, when I go to get my nails done, there's no one in there. And I think that's kind of interesting because I'm still getting my nails done, but everybody else doesn't seem to be doing that anymore. And I think there are a lot of things like that we used to do these things and we got out of the habit of doing them and we've not gone back to doing them.
The other thing is that COVID and the lockdowns and all that accelerated technologies because we relied on technologies to do things. So instead of getting on a plane and flying somewhere to go have a business meeting, a sales meeting or whatever, you did a Zoom call
Right.
And because of that, that's a complementary good to travel, right? Now, people are traveling again, but mostly they're traveling for leisure and for fun. But when people start replacing things with tech is cheaper. And tech is cheaper, and it scales cheaper as time goes on. Everything you do in tech costs less money, even though you're like, oh, but my phone was this much and all that. Yeah, but the value you get out of it is far more than all the things it replaces in your life, right? Because now that you have a phone, you don't also have to buy a camera, and you don't have to have, a laptop maybe, or all these other things. You just carry the phone around with you, and you can do everything from it. So the world has changed. Home affordability, call it a new paradigm, a new reality. It is what it is, but you can't just look at the price. Certainly, no, we're not pumping the market. We're not saying you should rush out and buy or anything. Just trying to give you data, but there's zero signs that there's a housing market crash. Like, it's not going to happen. And if we see everything trending that way, we'll be the first people to say it, and we'll laugh at everybody else saying they've been saying it for 2 years. But we're now saying it. When we say it, you should worry.
Right.
So you need to subscribe to the channel. You need to share this video, comment, and tell all your friends, because we're the ones that are going to know. We're going to be right, and everyone else right now has been wrong.
So all the people that are saying that the market's going to crash, they are right. Okay? They are right.
Maybe.
It will crash. But that's like telling you that you're going to die. They're right. You're going to die. We are all going to die. But is that going to happen today, tomorrow, in 10 years, or in 30 years? Same thing with the market. Is it going to crash today, tomorrow, in 10 years? When is it going to crash? To just say that the market's going to crash, that's not providing valuable information. What's providing valuable information is saying, what's the market going to do in the short term, in the medium term, and in the long term? And that's where we all make decisions. We make decisions based on a time frame. And the people who are, the Chicken Littles of the world, to them, everything is immediate. To us, everything is in different time segments, and that's where the value is.
All right. Thanks for watching this very long video. Subscribe, hit the notification bell, watch all other videos, and we'll see you next time. Bye.